If I asked you right now, what's a good credit score, could you give me a number? Most people can't. And that's a problem because this three-digit number controls more of your financial life than your salary does.
Yeah, it really does. I mean, it's kind of wild to think about. That one number is just predicting how likely you are to repay debt, but it dictates everything.
Right.
So the goal today is to really break down what a good score actually is.
Right.
And we're going to look at why chasing a perfect score is actually a complete trap and why the number you're seeing on your phone right now, it's likely wrong.
Okay, wait. I just have to say, I still find it crazy that a simple three-digit number has more power than an actual paycheck.
Hmm.
You know, like you could earn a massive salary and still get denied an apartment.
Oh, absolutely. Because the algorithm, it doesn't care about your salary. It literally cannot see your bank balance or your investments.
You can't see my checking account at all?
Nope, not at all. It only looks at your past behavior with borrowed money. Basically, out of 100 people with your habits, how many will default in the next 2 years?
Wow. Okay, so that clears up a huge misconception right there.
Yeah.
You could be a millionaire and have terrible credit.
Exactly.
So let's get into the actual scale. What numbers are we even talking about here?
So the whole system runs on a scale from 300 to 850.
Okay.
The bottom tier is poor, and that's anything from 300 to 579. Then above that, you have fair, which is 580 to 669.
And I'm guessing being in that poor or fair range just makes life really expensive. Where does the average person sit?
Well, the current average American score is 715.
Oh, well.
Yeah, which is actually right at the top of the good range.
Hmm.
Good spans from 670 to 739. And then above that, you hit very good, which is 740 to 799.
Right, and then there's the top tier, right? The one everyone stresses out about.
Yep, the exceptional tier. That's anything from 800 all the way up to 850.
Okay, so let's put this into like real world dollars and cents because I like to think of this as a financial GPA. But instead just looking smart on paper, this GPA actually costs or saves you hard cash.
That is a really great way to look at it. Let's look at credit cards first. Say you carry a typical balance and you have exceptional credit. Your interest rate is going to be around 17%.
And 17% still stings, but it's manageable.
Yeah.
What if you drop down to that fair range?
If you drop to fair, that rate jumps to about 25%.
Ouch.
Yeah. On a typical balance, that's an $845 penalty every single year. You're paying that just for being in the lower tier.
That is $845 just gone.
Yeah.
And it's not just loans, though, right? What about stuff like car insurance?
Oh, insurance is huge. In 47 states, a poor score means you could pay 40 to 115% more for car insurance.
Wait, seriously, why? Like, does being bad at paying a credit card make you a bad driver?
Well, insurance companies run these massive statistical models, right? And they found a correlation. Severe financial stress often leads to more accidents or property neglect.
Oh, I see. So if I'm broke, I might not fix my brakes.
Exactly. They just price in that statistical risk. But mortgages, that's where the dollar impact gets truly terrifying.
Right, because the loan is so massive. So what happens with a mortgage?
Let's say you're buying a house. The gap between a fair score and an exceptional score means a 1.5 to 2 percentage point difference on your mortgage rate.
Okay, 2% doesn't sound like a lot when you just say it, but over 30 years.
It's massive, that 2% difference. It adds up to about $400 more a month.
$400 a month? That's a whole car payment.
Yep. And over the life of the loan, it equals up to $170,000 in extra interest.
Wait, $170,000? Are you kidding me?
No, it's real. You're literally buying the bank a second, smaller house.
That is horrifying. Okay, we clearly need to know how this test is graded. How do they actually calculate it?
So there are 5 scoring factors. The biggest one is payment history. That's 35% of your score.
Okay, so just paying on time.
Exactly. And one late payment can drop your score by over 100 points instantly.
Over 100 points for one mistake.
Yes. And the worst part is it stays on your record for 7 years.
7 years? Why do they hold a grudge for that long?
Because they want to see how you handle debt over a long period, right? Through different economic cycles, not just when you're flush with cash.
Okay, fair enough. What's the second factor?
The second is credit utilization.
Right.
This is 30% of the score.
I hear that term a lot. What does it actually mean in plain English?
It just means keep your balances below 30% of your limit, ideally under 10%. So if your limit is $10,000, never owe more than $3,000.
Okay, but let me push back on this. What if I spend $5,000, but I pay it off in full every single month? I'm not carrying debt. Why punish me?
Because of how the system takes snapshots.
Yeah.
The algorithm doesn't watch your account every day. It just looks at a random Tuesday once a month.
Oh, so if it looks on the day before I pay my bill?
Exactly. It sees a high balance and assumes you're maxed out. But the good news is utilization has no memory. You pay it down, your score bounces right back next month.
Okay, that's a relief. What's the third factor?
Length of history. That's 15%. And this is why closing old cards is a terrible idea.
Right? I've heard you should never close your oldest card, even if you don't use it.
Yep. Because it calculates the average age of your accounts. You close your oldest card, your average age drops, and you look like a brand new borrower.
That makes sense. It's like erasing your high school transcripts.
Mm-hmm.
What are the last two?
Credit mix and new credit. They're 10% each.
Credit mix. What, like having different types of loans?
Exactly. An auto loan, a credit card, maybe a mortgage. It shows you can handle different types of debt. And new credit just means don't open 5 credit cards in 1 week.
Because you look desperate for cash.
Bingo!
Okay, so if missing points costs you $170,000 on a house, then logically, you should do everything possible to get a perfect 850, right?
Yeah.
So that should be the ultimate goal.
You'd think so, but no. Chasing an 850 is a total trap.
Really? Why?
First of all, less than 2% of people even have an 850. But more importantly, it doesn't actually matter.
Wait, what do you mean it doesn't matter?
The real finish line is 760. Lenders offer their absolute best interest rates starting at 760.
Hold on. So if I have a 765 and my neighbor has a perfect 850, the bank treats us exactly the same.
Exactly the same. You both get the same rate. And 850 is literally just for bragging rights.
Oh, wow. So pushing for those last few points is just a waste of time.
Complete waste. Plus, your score fluctuates every month anyway, just from buying groceries. Once you hit 760, you've won the game. Any effort beyond that is purely cosmetic.
Okay, that is huge. But that actually brings up a really frustrating real-world scenario.
Uh-oh. Let's hear it.
Okay, so you work hard, right? You check your free app, and you celebrate because it says you hit 740. But then you go to buy a house, and the mortgage lender tells you your score is actually 705. Why is the app lying?
Yeah. The app isn't lying to you. It's just using a different scale.
What do you mean a different scale? Isn't a credit score just a credit score?
Not at all. Free apps like Credit Karma, they use a system called VantageScore. But 90% of top lenders, they use FICO.
So it's like stepping on a scale at home, being happy with your weight, and then you go to the doctor's office, they use that heavy metal scale, and you weigh more.
That's the perfect analogy. They're just two different machines weighing your habits differently. Like, VantageScore cares more about payment history, but FICO might care more about utilization.
So my score can be different just based on who's looking at it.
Yep. A single person's score can differ by 20 to 40 points between the two. And with mortgages, it gets even worse.
How could it be worse?
Mortgage lenders don't even use the current version of FICO. They use an ancient version from 1998. It's called FICO 2, 4, or 5.
Wait, 1998, that's before smartphones. Why are they using something that old?
Because of federal regulation. The agencies that back mortgages legally required lenders to use that specific 1998 formula.
That is so frustrating. But I know you mentioned something about a 2026 revolution happening right now. Are they finally updating it?
They are. The housing market is finally adopting newer models. They're moving to VantageScore 4.0 and FICO 10T.
Oh, nice. Who does that actually help?
It is massive for about 45 million Americans who are considered credit invisible.
Credit invisible, like people with no credit cards.
Yeah, or people who just don't have enough history for the 1998 algorithm to score them. With the old FICO, you needed 6 months of credit history. VantageScore 4.0 only requires 1 month.
Wow, just 1 month. That's huge for, like, young people or immigrants.
It changes everything. Plus, the new algorithms look at things like rent and utility payments.
Yes, finally.
Yeah.
I've always hated that paying rent perfectly for years did nothing for your score.
Right. It was so broken. Millions of people who couldn't get a mortgage before will finally qualify now.
That's amazing. Okay, before we wrap up, I have to ask you about one thing. I am honestly scared to even check my score right now because I heard that checking it lowers it.
Yeah, no, I'm glad you brought that up. That is 100% false.
Wait, really? It's a myth.
Total myth. Checking your own score is what's called a soft inquiry. It has zero impact on your number.
So I can check it every single day if I want to?
You absolutely can. It won't drop a single point.
Awesome. Okay, let's summarize the absolute essentials here for you listening. If there are 3 numbers to remember today, what are they?
All right, first number is 670.
670 gets you in the door, right?
Exactly.
Right.
And the next is 740. That gets you competitive rates.
And the final one is 760.
Yep. 760 gets you the absolute best rates. You've won the game.
So seriously, go check your score for free today. Keep those 3 targets in mind.
And as you do, I want to leave you with one final thought.
Okay, what is it?
We just talked about how a three-digit formula from 1989 dictates your freedom. But if these new 2026 algorithms are starting to track your rent and your phone bills and your utilities,
Hmm.
are we moving toward a future where every single financial move you make is instantly tracked and scored in real time?
Oh, wow. Yeah, that's a lot to think about.